The market, which gave a very nominal return in 2025, did not start in a very great note even in 2026. Such global uncertainties always go in favor of gold because of its safe haven nature, which also disappointed because oil as a factor impacted inflation. And there are fears of a higher inflation, and also that can become a reason for central banks to raise interest rates. And the de-dollarization efforts which were done by many countries also took a halt in this scenario, and that also led to gold being ditched as an investment option, and gold also witnessed a big fall. Right from the start of the war till a day back, gold was down by 12% and silver was down by 14%. If you take India, the biggest blow among the major sectors has been taken by banking.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
March has been a shocker for most investors. The market, which gave a very nominal return in 2025, did not start in a very great note even in 2026. When people were remaining in hopes, were expecting the earnings to recover, and we were expecting an imminent recovery, came a shock in the form of the West Asia war. The war literally disappointed investors, not only equity, even commodity investors, because such global uncertainties always go in favor of gold because of its safe haven nature, which also disappointed because oil as a factor impacted inflation. There are fears of a higher inflation, and also that can become a reason for central banks to raise interest rates. Then you also have the dollar, which is getting stronger. All these reasons put together gave a negative trend to gold, and the de-dollarization efforts which were done by many countries also took a halt in this scenario, and that also led to gold being ditched as an investment option, and gold also witnessed a big fall. Right from the start of the war till a day back, gold was down by 12% and silver was down by 14%, just in about less than a month's time. So you have markets which are down, you have gold and silver which is down, and markets globally also are down. If you have to make a tactical investment now, where will you invest? Go through the video and don't stop. Continue till the end, and you have a lot of options coming in for you to make wise investments and to make that smart money. While we say that, please take care of your asset allocation. Don't make tactical allocation which will jeopardize your asset allocation. Asset allocation has to be intact. Any tactical investments, and only if you have that risk appetite, have to be played, but within the proportion of your asset allocation. If you take India, the biggest blow among the major sectors has been taken by banking, because inflation, which may lead to a rise in interest rate, is a big dampener for the prospects of banks. This will pull down credit offtake in a big manner, which is a very negative news for banks. Given this reason, you see almost all the major banks taken a big fall from the start of the war. Now, how will you take exposure to banks? If you have a very high risk appetite, you can take exposure through the banking and financial services funds. And there are also pure bank funds. There are also private bank based passive funds. You can take exposure into this. And as we speak, the banking index has taken a 10% fall since the beginning of the war. Such is the drop which is available, or such is the attractive price at which these stocks are available. So you can buy this. Basically, you can even buy the index funds rather than buying the stock of any particular fund. Rather than buying the stock of a particular bank, it's better to take a fund exposure which has a mix of a lot of banks. Now, if you don't really have that exposure, now if you don't really have that risk appetite, you can also play it through diversified funds. Why? Diversified funds tend to have 30 to 40% exposure in banks itself. So the fall in the banking stocks is very much there in your diversified funds also, to the extent of the weightage they have. And it's not only the banks, even the other sectors have taken a beating, right? You take across, you take a pharma, you take a cement, you take a steel, you take real estate, you take FMCG, all these stocks have taken a beating, and that means all these funds also are available at a relatively attractive price as compared to the price they were in the end of February, right? So opportunities are available for high risk investors with banking funds, and not only that, you can even buy other sector funds, because if you take funds of FMCG, they have also taken a beating. You take funds which have major holdings in real estate, they also have taken a beating. So you can buy the respective sectoral funds, but it's safer to buy the diversified funds. And this doesn't restrict only to large. Across board funds or the market caps have taken a beating. Large, mid and small caps all have corrected during this fall. So people who have been staying away or reducing exposure to small caps can also start thinking about it, because stocks are available. The market is also available at a reasonable price after this correction. Now, India has become on par with US in terms of the valuation of the markets. It's better than markets like Japan. Only very few markets like China are attractively valued as compared to India. But if you take the major economies, India is kind of closer to the valuation or on par with the valuation of most other countries. So that gives an opportunity for even FIIs to consider buying in India once the war settles. Is the only opportunity only in these funds? No. Most of the major markets have corrected. Japan, Korea, which was the top performer of last year, Taiwan, Hong Kong, and even China have corrected a lot. And not missing US from the list, US also has corrected. If you have to invest in global markets, and it's sensible to have an exposure of global stocks in your portfolio through global funds, and you can take exposure into global funds also through various funds. We can suggest you on the right kind of funds which will suit you, and buying those funds in this kind of a market, again only in a phased manner. What was told from the beginning till now, please keep in mind, we don't suggest putting all your eggs on a single day, which means we don't suggest investing the entire money on a single day, as it's only a pause which the war has taken, and it's not a real pause. At least only Trump has told that there will be a 5-day pause. Otherwise, the war has still not come to an end. Uncertainty remains, which means volatility can continue. India VIX is also at a very high level. If you have to cash in on the volatility, we recommend you staggering your investments across all the suggestions we gave over the next 8 to 10 weeks, and buy through the systematic transfer plan route of mutual funds, where you park your money in liquid funds and invest in the destination funds over the next 8 to 10 weeks. We told you about the global markets which have corrected, but the right funds, probably you will have to sit with us to understand which are all the right funds. You can approach us and we will give you the solution. Also, gold and silver also offers you opportunity in the current market. The correction of about 10% in gold and about 12% in silver since the beginning of the war still throws an opportunity to buy these metals at a very attractive price. And gold has its opportunity, but it may not give you the real ultra short-term kind of gains anymore. Don't look at that. And silver also offers opportunity, provided you have a medium to long-term view. You can't look at these metals for a 1 month, 2 month kind of a scenario. The opportunity which was available somewhere in 2025 is no more available in that such a fast pace. So please keep that in mind. Have a relatively longer time frame in mind for you to invest in gold and silver. And even in gold and silver, volatility can prevail, as the war can still throw uncertainties and surprises. Buy even in gold and silver through the mutual fund route, through STPs, to average your cost and cash in on this volatility, and to make some decent returns over the medium to long term. One thing to be kept in mind is not to ditch equity, not to completely trash gold and silver as an investment option and move all your monies to the safe FDs because of this uncertainty. You have seen COVID. Many of you started investing seriously since 2020 after the fall in the markets. There are many of your friends who moved away from the equity markets when they saw the market fall during COVID, and ask all of them who left markets at that point of time. All of them were completely taken aback, and they never saw a big reversal coming in the next 5 to 6 months, and they lost opportunity by not remaining in the market and by abandoning the market and leaving from a market. Ask them, they will tell you the pain of leaving equities and moving away to other asset classes. There are very recent examples such as that, and many of you have made decent returns by investing during the fall after COVID, and this is also an opportunity. If not to that scale, yes, it's a good opportunity. So our past, particularly the COVID phase, has lessons of how attractive investing in a falling market is, and how painful it is to leave equity markets and move away to other asset classes trying to time the markets. So the lessons are so raw and fresh in your minds. If you have not gone through that, ask from your friends who have gone through that. That will tell you why we are insisting the importance of asset allocation, importance of not tinkering too much with your asset allocation because of a market phase like this, and don't miss opportunity of buying in such markets, yes, in a phased manner with whatever surplus you have. You can reach out to us for customized advice on all these investments which we discussed, and for any other financial planning related queries which you have, and we are happy to advise. Please reach out to us through the contact numbers given, and we are there to help you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.